All right, welcome to this explainer. Today we're unpacking one of the most fascinating contradictions currently playing out in the market. We're looking at Accenture, the global consulting and tech powerhouse, to try and understand a massive disconnect between its recent financial performance and the market's incredibly violent reaction to it.
Here is our analytical roadmap for today. We'll cover the earnings price paradox, the growth and profitability baseline, the anatomy of the crash, the dialectic between the bear and bull cases, and finally, future catalysts and risks.
Section 1. The Earnings Price Paradox. I really want to start with this central question because, frankly, it completely defies standard market logic. Think about it. In the third quarter of fiscal year 2026, Accenture reported expanding margins and generated a staggering $3.6 billion in free cash flow in just a single quarter. And yet, the market reacted as if the entire business model was suddenly collapsing underneath them. The result of that panic was an 18% single-day stock crash, literally the worst on record for the company. It wiped out billions in market capitalization before New York even reached lunchtime. So to figure out if this is a classic value trap or a truly rare generational buying opportunity, we have to dig into the actual numbers.
Section 2. Growth and Profitability Baseline.
To really grasp the scale of the panic here, we first need to look at the financial foundation of the business. Accenture's global operation is just a massive, historically resilient beast. Building on a solid previous quarter, Q3 showed broad-based revenues across the board. We're talking $9.1 billion in the Americas, $6.9 billion in EMEA, and $2.7 billion in Asia-Pacific. They're generating incredible cash across completely diverse industries, from financial services right through to health and public service.
And on paper, the actual numbers describe a very healthy quarter. Revenue hit $18.72 billion, which is a 6% growth year over year. Adjusted earnings per share was $3.80, beating consensus estimates by up to 9 cents. Even their operating margin ticked up by 20 basis points to 17.0%. If you zoom out to their most recent full year, fiscal 2025, they generated an unbelievable $69.7 billion in total revenue. Get this, they have never recorded a full-year revenue decline, not once. This proves we are dealing with a highly profitable, massive, deeply entrenched franchise.
Section 3. Anatomy of the Crash.
So, the crucial point is this. If the past and the present look so good, what triggered an 18% plunge? Over roughly the past 5 years, Accenture has largely been a steady compounder for investors, practically the textbook definition of reliable tech consulting. But you know how Wall Street loves to overreact. The stock was already suffering from pre-earnings anxiety, having fallen from its 52-week high of $314.20. Then the Q3 earnings report dropped, and instead of reassuring the market, it sent shares into a free fall, crashing down to around $187.
The thing is, the sell-off had almost nothing to do with the current performance we just looked at. It had everything to do with forward guidance. Management guided Q4 revenue to a midpoint that was a 2.3% miss on Wall Street consensus. And more importantly, they trimmed the upper bound of their full-year revenue growth forecast from 5% down to 4%.
The market essentially spooked over 3 distinct headwinds. First, new bookings dipped 2% year over year, which suggests a thinning pipeline in the near term. Second, management cited a direct $400 million revenue hit due to the conflict in the Middle East, pausing their consulting business in the region. And third, sluggish procurement cycles in their U.S. federal business are creating a 1 to 1.5% drag on total growth.
Now, compounding all of that anxiety was a massive capital allocation announcement made that exact same morning. Management dropped a whopping $4.18 billion on an M&A spree to acquire cybersecurity firms Dragos, RunZero, and NetRise. Look, strategically, it's totally sound for expanding their footprint in a critical sector. But spending over $4 billion at the precise moment your organic growth is decelerating, well, it created a pretty uncomfortable image for already nervous investors.
Section 4. The Dialectic, Bear versus Bull.
Now we have to weigh the two contrasting narratives fighting over the stock's future, because this is how we form a clear investment view. Underneath all the data sits the ultimate AI paradox. The bear case fears that artificial intelligence is simply going to automate away the legacy consulting and billable hours that built Accenture in the first place. But the bull case argues the exact opposite. They believe early enterprise AI adoption is incredibly chaotic, fraught with data failures and integration breakdowns. And resolving all that chaos demands massive, external expertise, the kind only a firm like Accenture can provide. And, the recent data actually leans heavily toward the bulls here. Accenture tripled its advanced AI revenue in a single year, growing it from $900 million in FY 2024 to $2.7 billion in FY 2025. They even booked $2.2 billion in advanced AI work in just Q1 of FY 2026 alone. That proves they are still winning new transformation work at an absolutely massive scale.
Because of the crash, the valuation is sitting in historically unusual territory. A forward PE under 10 for a franchise of this quality is something value investors usually only dream about. I mean, it's near a 10-year low. The free cash flow yield is up around 14%, and the dividend yield has spiked to roughly 4.1%, which is 165% above its 10-year median. Management saw this valuation and essentially called the market's bluff. CEO Julie Sweet flat out stated that the share price does not reflect the strength of their fundamentals. And they didn't just talk the talk. They backed up those words by authorizing a massive $7.5 billion share repurchase program. That is a 62% increase in buybacks year over year.
Section 5. Future Catalysts and Risks.
As we look forward, let's outline precisely what will determine if this discounted valuation is a value trap or a generational buy. The catalysts for future growth really hinge on capturing a massive $240 billion mid-market space through a new initiative called Accenture Edge, as well as successfully integrating those $4 billion in cybersecurity acquisitions. On the flip side, the risks are very real. You have this persistent fears that AI will eat into margins, combined with a cautious enterprise spending environment where flat global IT budgets continue to delay large megadeals.
So I'll leave you with this final thought to help form your own investment view. As literally every major enterprise on Earth attempts a complex, chaotic AI transformation over the next 5 years, are they going to need less external help doing it or infinitely more? Your answer to that question will likely tell you exactly what you should do with this stock. Thanks for joining me on this explainer.